and welcome to Money Matters. My name is Jim Butler with Videre Wealth Management, and my co-host tonight is James Chan with Asia Marketing and Management. Welcome, James.
Thank you, Jim. Good to see you.
Good to see you too. Well, there's always exciting times, and the media is never short of giving us something to talk about.
Daily.
That's right. So even though we don't want to date ourselves with this program, of course, 2018 has been very exciting. There's a lot of developments going on, not only from an economic standpoint, but from a global standpoint, and certainly politics in Washington just adds to the flavor of things.
Right.
What I'd like to start out our conversation with is more from a global standpoint and how it relates to an investor's portfolio. So you've certainly heard the conversation about asset allocation, diversify your portfolio, invest globally, invest domestically. And so maybe for the benefit of our listeners tonight, we can talk a little bit about the benefits of global investing and why this is something that they should make sure they're participating in most of the time.
Right. Well, first of all, I have to say I'm not a finance person, so I'm not going to go into the nuts and bolts of the financial calculations and all the jargon, because that's not what I do anyway. However, I do deal with China on a daily basis, beginning from 1980. I mean, because I invented my practice. I used to work for a Fortune 500 company as somebody who opened the China market for the firm, and I found success. And somehow one thing led to another. I started, founding my own consulting practice, and my focus is to help American companies market and sell American-made, 100% American-made products and later services, much like financial services, to China. So I've been doing it since 1980, and throughout the few decades, really, China really has grown from basically zero to now that seems to be even threatening to some people, America. So talking about global investment, whether or not China is a good boy, a bad boy, it's still a boy you can't ignore. So, and in a way, I mean, I have my own wealth management company doing my money.
There you go.
Because I don't believe that I know anything, so I rather have people like you help me than to do it myself. And they have been insisting that my portfolio should be reasonably diversified. And to cut to the chase, actually, even though I don't even know how to read those financial data well, I kind of know that if the Dow drops several hundred points, that doesn't mean that my portfolio will collapse because of the international chunk of it.
Right. So let me step back for a moment, kind of set the table with regards to this global asset allocation idea, and then come back to maybe a little bit of your expertise, and certainly that ties into our question from one of our listeners. So the primary benefit of asset allocation is really diversification. And it has to do with the concept that you want to invest in different asset classes and different opportunities to the point where you may not make a killing in any one area, but you're also not going to get killed by that same area when it goes down. So as a result of diversifying both domestically and international, you're safeguarding the total portfolio, as you just alluded to a few moments ago. When you move to the international landscape, you are probably aware that you have several different countries, of course, but they are categorized into developed or developing. Developed are your more traditional countries, those that have a more stable economy, like Japan, England, Germany, France, and so on. And those economies do not mirror the United States, although there are some correlations. When you then take it to the developing countries, which are your more emerging markets, such as China, India, Brazil,
Correct.
Pakistan. So in those cases, the short-term movements of companies in those markets tend to be wider in terms of dispersion, both up and down. They also present some interesting opportunities.
Correct. Correct.
And so would you say that based on your extensive experience in dealing with business in China as well as the United States, that you have seen some of those business opportunities in fact flourish in China as a result of the relationship?
Oh, plenty, really, of course, sure. In different sectors, sometimes it's the rural sectors, others will be the high-tech sectors. It really varies, even including some toy manufacturing. I used to work for, like in 1990, I actually did quite a lot of work for a Christmas ornament manufacturer, and we did extremely well. So I'm agreeing with you that you really cannot predict which sector will go up and which will go down. And so you really need people who have to study all these daily and pay attention. So almost like playing the piano. If you don't really know how to play the piano, you don't even know which key to push. And sure, absolutely. And I made it very clear to my management company that I put all my energy on China, so please diversify. Like don't put all my assets into China because this is what I do. Yeah, I don't know whether I'm making sense with you, but that's, I understand. I agree with the whole concept of diversification. Right.
When you look at the international landscape, because you want to be diversified for the reasons that we talked about, if you have unique insight or knowledge, you can certainly invest in that manner. So you might have some opportunities in China just because of your expertise, but the majority of people don't have that. So in my view, one other layer with regards to international investing is to hire an active manager over a passive manager. There's a place for passive funds, which are typically index funds, in the international landscape. However, I think there's a very strong argument in favor of active management for reasons that we're touching on, which allows that management team to really decide what weight to put into the emerging markets, developed markets, and be able to balance those over time.
Absolutely, and in a way, it's so funny when I was coming here for this episode of Money Matters TV, I couldn't help it. I had my iPhone, I was just playing with the apps and I was looking at the stock market.
Yeah.
And unfortunately, the Dow dropped 356 points.
Today,
just as I was coming here an hour and a half ago. But I said to myself, oh, it's okay, don't panic, James, don't panic, because it doesn't mean that everything drops. Because my manager knows how to even out things. If it makes some sense, well, at least from I'm kind of like speaking from a client's point of view, not a manager's point of view. I feel better knowing that somebody is taking care of it.
So if you go to the store to buy a new suit of clothes, and you want a suit and a shirt and a tie, would you be more interested in making that buying decision if that same set of clothes was on sale when you happen to be there? Would that entice you to make that decision a little bit sooner?
Not necessarily. I think in my case,
the same suit of clothes, if you went on the day that you wanted to buy it, and it happened to be on sale, in other words, the prices of those items were lower, would you be more inclined to buy?
Well, the temptation is I will be more inclined to buy if I know that it used to be higher. Or much higher.
James, my only point
is temptation. I said that doesn't mean that I would buy, but I just temptation. I'm going to be very honest.
Okay.
It's about self-discipline, though.
I understand.
Yeah. But I'm trying to answer your question.
You are. So when the market comes down,
Right.
such as you alluded to a few moments ago,
Right.
those are buying opportunities. The media won't tell that to to those of us that listen.
Right.
They would spread more of a word of panic, but I view that as
Right.
more of a buying opportunity. Let me shift gears, if I could, however, to the question that was sent in by one of our listeners.
Okay, that's good.
So Frank Young in Philadelphia is asking the question, James, what are some economic trends that you see in business today with regards to China?
It's a very broad topic. I do have a few things to share because I have to talk to my agents every day. Philadelphia is some 12 hours behind Shanghai and Beijing and Guangzhou. And so a few trends I have observed over the past few weeks, particularly with the US-China relations getting kind of rather rocky, to say the least. And I think the first trend I feel, and I believe this is not just temporary, but kind of going on for quite some time till the future, is China will because of the U.S. attitude of thinking, oh, you have eaten my lunch, so I'm not going to let you do it anymore. So I think that the Chinese, instead of backing down and say, yeah, I'll let you, I'll abide by whatever terms you want me to do, I think China is going to go back to even being more inward oriented, meaning if I can make whatever I can make at home, I'm not going to buy it from America. That's trend number one. China going inward. But when I say going inward, I don't mean China necessarily becoming isolated. I'm saying that China wants to be more self-dependent, more self-sufficient.
Okay.
Now, but of course, China doesn't make anything. China doesn't have everything. China still has to buy from the outside world.
Sure they
whatever
do.
outside world is, the developed countries or the developing countries.
Right.
So for that's trend number two, that China will continue to buy and particularly sell to countries other than America. So I think that the current U.S.-China climate will only push China, that's trend number two, to, if they need to buy something or raw materials, sophisticated products, they will source from Europe, from Japan, from other places.
Let me ask this question.
Right.
Do you think that eventually that stand may soften so that the U.S. and China relations could in fact open up in time in order for them to be more productive and more competitive?
Absolutely yes is the answer. I have no doubt. But whether or not we are going to wait for 1 year, 2 years, or 3 years, we don't know. But because, you know why I'm so confident saying yes? Because I started in 1980 and I have seen, I have to get my English right, I have seen U.S.-China relations kind of like a sine wave. It goes up, good, China bad, China good, China bad. It's like the stock market. It always goes up and then comes down. There's always somebody bitching and moaning and attacking. So,
James, that speaks right to the cyclical nature of business and markets. And I think that also speaks well to a message that we want to share tonight.
Right.
And that is, you're better off with a long-term view in order to work through those cycles versus having a short-term view and trying to time when those cycles are going to move one direction or another. But if you have a longer perspective and can turn down the noise that comes from the media, I think you're going to be better served.
Absolutely. And let me quickly go back to your idea about the suit, being now marked down. Am I tempted to buy? Of course I'm tempted to buy because, wow, what an opportunity. But if I were to do that, I might be lacking self-discipline.
Okay.
Discipline. I might be lacking discipline, which is exactly what I need from my wealth management company. They will have the discipline when I may not.
Okay, good. Thank you. Good answer.
Oh yeah.
And if you have a question that you would like our panel to answer, please send it in at the address that is in front of you.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says Send Us Your Questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
Our guest tonight is Steve Smolinsky with Benari, a business consultant, and he takes a very unique approach. Welcome, Steve.
Thank you. It's a pleasure to be here.
So for the benefit of our listeners, tell us a little bit about Benari and what makes you unique.
Benari is a consultancy that I formed with my father many years ago. And he was a international consultant for a major international consulting company. So we started off in the C-suite of big international companies, advising them on strategy and organization and being trusted advisors to them for all the things they wanted to talk to somebody about that was not in the company, was not part of McKinsey or Booz or whatever big consulting company they were working with, but could just give them absolute honest opinion without any coloration, without any softening, without anything. The one thing that they often lack is somebody that's willing to just walk up to them and say, that's the stupidest thing I ever heard.
Right.
You know, what are you thinking? And I might not be right, but if I think that, there's probably other people in your company that are thinking that haven't been willing to tell you that. And at the very least, you need to do some exploration, some further thinking, some discussion with some other people, and investigate to see if I'm right or not.
Right.
And they don't get that. Nobody's willing to talk to that. And since then, I've gotten involved in a lot of early stage companies, as well as still doing things with the larger companies and internationally. And what I've noticed is that carries across everybody at every level who's sitting at the top of the pyramid.
That they want that unbiased, direct and honest feedback.
They need somebody to say, really? You're really thinking about doing that? You know, and they don't get that, and they really appreciate it. And one of the things that I do when deciding who to work with is I have my little series of questions I ask them when we talk and when we meet. And I'm trying.
Give us an example.
And I'm trying to figure out a couple things. I'm trying to figure out, do they actually want to be fully, totally open and honest? And do they want to hear my open and honest feedback back? Because if they don't, I don't want to work for them. Because what I know is they're cutting off the most valuable service that I can give them. And what's the point then? And obviously that's the most exciting thing for me. And I'm also interested in people that are fun to work with. So I have just a routine that I go through where I discuss with people, so what's your financial situation? Not what you post out there all the time, but what's really going on. It's amazing. You can see whether someone's going to talk to you or not if they talk about that or they're willing to share it. And I appreciate in the first talk they're not going to tell me things they shouldn't. I'm not talking about that, but just an open and honest discussion about what's really going on. And what's the status of your people? Do you have good people? Do you have bad people? Are you nervous about your people? Do you have a senior guy that you'd really like to get rid of? He's not up to speed. And I just go right for it, right in the initial conversations. And a lot of people will talk to me and they'll share stuff. And I'm like, that's a good client.
So do you receive a lot of business opportunities through referrals, word of mouth?
100% is referrals. It's really hard to advertise and say, I'm a world person who knows a lot about what's going on, have worked in a lot of industries, a lot of countries, and you can trust me to tell me anything. So call me and we'll talk. I mean, you know, it sounds kind of silly. Right. So usually what happens is I get, these days, a text introduction or an email introduction, and it says, Steve, you need to talk to Jim. And Jim, you need to talk to Steve. I've told you each about the other one. It's now up to you. Have a conversation. I think you'll find some points of common interest and some ways that you can work together. And what I've noticed is pretty much 100% of the time when that happens, that is in fact true, because it's pre-evaluated, right? Because the person who sends me along has already decided this will work.
Steve, I have a question. I've known you for many years.
Yes.
You know, back from the Mid-Atlantic Consultants Network days.
Great fun.
I mean, I was there for 18 years. And of course, we've been consultants for the longest time. And I have a pretty difficult question for you, not about you, not attacking you, but about the idea of even under referral, even somebody who is equally trusted by you and a potential client, when the two of you meet, will personal dynamics, just the idea of rapport, or to use a more dramatic word, bromance.
Yes.
Bromance.
Yes.
Nothing hanky-panky, just bromance. Personal chemistry.
Yes.
You can have two people who should trust each other, still can't get along. Do those cases happen?
Sure.
I really want to know.
Sure. Sometimes somebody is sitting across the table from me or wherever we're sitting in a coffee shop, or on the telephone before you even get there. And as I'm talking to them, what I'm listening for is, what are the signs of what you're saying?
Oh, yeah.
Do they say something that is just abhorrent to me that I'm not going to work with them? And a true example of that is, I'm an older white guy. I'm meeting with somebody who's an older white guy, and who assumes that I will share some of the not so nice older white guy things that are floating around out there, and makes a horrific racist comment to me just as part of the conversation, not as, and I immediately know, I don't care what the story is, this isn't somebody I can work with. And that happens. Thankfully, it happens exceedingly rarely, but it does happen. You know, and that's an example of it. And then I'm gone. I will not work with them.
So personal chemistry does count.
It's gotta work. It's gotta be somebody that I feel shares the values that I have about honesty and openness, and that everybody should have opportunity. And frankly, every Tuesday I send out the Benari blog, where I write a few hundred words on my thoughts on leadership and management and whatever happens to happen that catches my interest along that. And by happenstance, recently one of them was about this topic. It was about the fact that you need to be in a place where the values mesh, where you should be talking to people and working with people that you are going in the same direction with them. You're aligned, you're on the same page, let's say. Because A, it's a lot more fun to work with people like that. B, I frankly really don't want to spend much time helping anybody who's a racist. I mean, it's not in my world. And C, you do better work with people that you're aligned with, that you can work with in anything, consulting, or if you have a restaurant, your best customers are going to be the people that love the food you do. They like you, they connect with you, right? Anything.
Absolutely.
And they're the ones that are going to come back every month and become your regular customers.
So let me ask you this, given that as a backdrop, just with regards to who you choose to work with, as I mentioned earlier in this show, we don't like to time the taping of this because it's broader in terms of time period. What do you see in the business climate, both within the U.S. and even on a global basis? You mentioned you do a lot of work with startups. Are you seeing a lot of innovation taking place on a global basis?
I think that what's happening today is the cycle of everything is now measured in, I don't know, minutes or microseconds maybe, instead of what we used to have, which is decades, and before that maybe centuries. And you know, it just keeps shortening. And there's a lot of fear out there because there's a lot of people that are looking around. They don't understand what's happening with technology. They see a company like Amazon go from nothing to be worth $1 trillion in, I don't know what, 15,
Very
18
short,
years
very
or something
short.
since they were started. And they see General Electric go from whatever the value of General Electric was to like 1/10 of that now, or 1/4 of it, or whatever it is currently. And it scares them because General Electric had a lot of smart people working there.
Right.
And they still weren't able to take advantage of what's happened, and they were passed by. So to me, what's happening is a lot of clever young people and not so young people are going out and saying, I'm going to be disruptive, I'm going to find something, I'm going to figure out how to do it, and I'm going to put my time, my energy, my effort into it, and I'm going to make it work. And they're hugely confident. And to the extent that existing companies have hardening of the arteries, they're going to be run over. They're totally going to be run over. And people, for some reason, aren't able to notice things as fast as they should, or if they notice them, they're not willing to take a step back and see it as a real threat. And my example right now is the taxi industry. I mean, the taxi guys all knew that Uber was coming when Uber was pretty little and was just starting, and they knew what Uber was doing, and they knew Uber was their competition, and they knew it was cheaper than them, and they knew it was more convenient than them, right? You could go right down that list. And what did they do? They kept doing what they were doing.
You're right.
And
To this day.
To this day.
this
And
day.
I'm convinced if a couple of the bigger taxi companies that had some resources had scratched their heads and said, wait, let me go find some smart young technology guys that can see what Uber's doing and create that for me, and I can have my cabs and I can be Uber.
Right.
Some of them could have been hugely successful because they had the resources that Uber didn't have originally, but they didn't do it. And Uber and Lyft are out there eating their lunch.
Yes.
And you know, we were talking about China. There's a huge company, I don't remember the name of it, that's like them in China. It's doing the same thing in China.
Oh yeah, yeah,
Right?
yeah.
And you can't go that way today. You've got to be able to switch as everything comes down the road, and be comfortable with it, not be fearful of it.
Would you think, Steve, one way to combat that inability to look forward and to innovate for some of those either bigger companies or those that have been around a while is through diversity? In other words, hire more people that aren't like you, that might be younger, that might, you know, if all you have are white guys, then you need to hire some women, or you need to hire some minorities. In other words, diversify so you can get more creative
You
and more
must be
ideas.
channeling my blog. This morning, literally this morning, before I came here, I wrote a blog which is going to come out next Tuesday. And it was on the fact that McKinsey just recently did a big study which showed that if you have a gender diverse leadership team, you're 25%, you're in the top 25% in profitability of companies over everybody else.
That's huge.
And if you have a gender diverse plus an ethnic and culturally diverse leadership team, it goes up to 35% above the average.
So ideally we could continue this discussion, and we probably should, but we need to wrap in order to stay within our schedule.
Okay.
Our next guest is going to be Marion Krott from McMusic and Entertainment Services. So be sure to tune in next time and listen to what Marion has to say. And then, otherwise, thank you for listening to Money Matters.